The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.
Hi Warren, hope you are doing well. I just had a couple questions. I've been following the podcast for watched or listened to all the episodes. Just get straight into it. I've maxed out my tax-free savings for the year. I've got my 3 months sort of emergency supply, as you call it, and I've still got a whole bunch of extra money in a sense from my salary that I can put into, that I want to put into something. So I just wanted to know, where do you invest that into ETFs still on whatever platform you use? What's sort of the play there? I know we're going to get taxed on it, but what sort of alternative investments do you like? I've got a pretty long-term horizon. I'm still 24. And then secondly, I had quite a bit of money in the US stocks, and obviously they've run quite hard. And I just wanted to know if you think that taking it out of that and investing it more diversely would work, or if you think if it's for a long time horizon, just hold, or do you think maybe sell at the top and then buy it when it dips a bit, or what's the sort of play?
So I love this question, I must say. So 24 years old and fully funding a tax-free savings account and building up other investments as well, and now asking great questions around what do I do to keep building up my investments. And I think maybe just to get into that order of priorities, I think you and I we probably differ slightly, but just from your perspective, if you've got the money, what do you do first, second, and third?
Yeah, I like the baby steps from Dave Ramsey, the American kind of financial educator that I kind of use as making conceptualize more South Africa. So in my mind, if I have to start at the very basics, I'd like to say step one is always have a budget or a spending plan. You need to know where your money is going. Step two, have 1 month emergency fund just to make sure there's a buffer. Step three, pay off bad debt, credit cards, personal loans, deal that. Step four, get a 3 months emergency fund just to add that buffer. And then we get to step five, which I would say, now that you have that solid foundation in place, now it's a good time to look at a tax-free savings account, especially if you're still young, because that grows tax-free. The annual limit to that is 36,000, so I'll build up to that. And then that is kind of where the listener is currently at. So in my mind, is at maybe step five in that sense. So now what's the other 5 steps? What do we do next? So I would start off by saying, in a country such as South Africa, where we are heavily taxed on many different avenues, we always need to try and make sure that we benefit from the few tax breaks that we have. Now, I'm very glad to hear that he's already maxing out a tax-free savings account at the age of 24. That's awesome. Like, well done. So my next obvious step would be looking at something like a retirement fund. So if he has a pension or provident fund at work, his employer is probably contributing to that. So maxing that out or starting out the retirement annuity at another platform. It now also depends on kind of what his marginal tax bracket is and how beneficial that would be. But I still think the tax-free growth for him, 3-4 decades is going to be magnificent. And at least in my mind, I'd say kind of matching what you put in a tax-free savings account into something like a retirement annuity to benefit from that long-term tax-free growth and get a bit of a tax deduction and hopefully a tax refund at the end of the year. And after that, then it becomes a bit tricky because we don't necessarily know what other financial goals he has. Maybe he wants to buy a house, maybe he wants to buy a car, saving for deposit. So that will then mean don't use your tax-free savings account for that. Use a normal taxable savings account, save in a more conservative type of investment if it's 2-3 years away. Maybe he wants to get married, so there's saving for the wedding. So I think that before we kind of, the other side of the question was US stocks, and we'll get to that later on in the episode. But I think before we jump into that space, we also need to think about saving for retirement, but also short and medium term goals, because those things also need to be saved ahead for. Otherwise, we're going to have to take a lot of debt, and then debt starts to creep in, and then our investments will shrink. So that would be my next steps after tax-free, looking at maybe an RA and then short, medium-term financial goals, funding that first before we really move to the taxable side of things. And we assume he doesn't have debt as well, because that would also be a priority then.
I mean, I think that should be a non-negotiable. If you've got credit cards, personal loans, overdrafts, microloans, loan shock money, whatever it is, all of that needs to be out of your life. We have spoken about this in previous episodes, but at 24, the other thing that's very valuable there is stay off the property ladder for a little bit of time, keep building up capital. I love your point. If you plan to buy a house at some point, putting in a lot of money that you could just whack in a huge deposit on a house would give you a lot of freedom to then get that bond down as fast as possible. And I think that for people in that situation, letting the capital compound now, so building up your savings as fast as you possibly can, so that you're prepared for when life gets much more expensive. If you're single and it's just you and your costs are low, then use that time, which it sounds to me like this person is doing, and as you said, it's an incredible job. Then you want to build up your capital, your long-term capital, as fast as you can now, because later, then you can take the foot off the pedal a little bit to say, well, actually, life is more expensive. I've got financial dependence I need to look after. But you don't want to touch your savings. So what you want to do is let your capital keep growing. And then you've got your investments that can just grow unfettered by drawdown. So I think that there is a balance there. I think you're absolutely right. If you want to set aside money for a biggish purchase as opposed to long-term financial freedom goals. So if it's a car, if it's you mentioned weddings. I always think don't spend on the wedding, spend on the honeymoon. But that's just me. Do those things with money that's only invested for specific goals. In other words, if it is 3 years, then please don't go and put that into a global equity fund. It doesn't make sense because Murphy will teach you a lesson, and what will probably happen is that global equities will fall by 40% at exactly the time you need to put the money down to buy the house, the car, the wedding, or whatever it is. So low growth, yes, I understand, but also low risk investments for fixed purchase in a shortish period of time. The moment you go through 5 years or longer, please don't put it into a money market account or fixed deposit. It doesn't make sense. Then you can take more risk. You've got more time. So I do like your order of priority there. I think I'm trying to find ways to disagree with you, Pieter. I'm not succeeding. So I think then the maybe the one thing just to talk about with retirement funds, the advent of the two-pot system. What's actually happened, I think, for people who are very good savers in retirement funds, this should be seen as a great innovation. Why? Because you want to maximize your tax breaks that you get from SARS. We get so few of them. You want to get the tax-free growth. And at the same time, if life happens and you have to use up your emergency fund, it's not the same as it was in the past. There will be a portion of your retirement fund that you can access. Let me repeat myself. In an emergency, and a new cell phone, a new handbag, a new laptop is by no means an emergency. I'm talking about you're going to get kicked out of your house, you can't feed yourself, you can't pay your medical aid. That's an emergency. Then you can access a portion of retirement fund. So that's why I think the encouragement that you're giving someone to kind of maximize that retirement fund contribution, I wouldn't have agreed with you 2 years ago. Because that liquidity issue, the accessibility of the money is always a concern for me. But now you can. So yes, go for it. Maximize the retirement fund contributions as well. Once they've done that, maxing tax-free, maxing retirement fund contributions, emergency fund, I think if your salary is predictable, 3 months is fine. If your salary is wild and crazy, you're a professional sports person, you work in the gig economy, maybe look at a 6-month emergency fund. But if you've done that as well, now we're into the fun stuff, the longer term investments. What do they look at?
Yeah, I think if you reach that point, so in my mind, that would now be around baby step 7. So we've got the RA, we've got the tax-free, we've got the short, medium-term goals. Now I still have money. It's a good problem to have. What do we do now? Now we're kind of moving past the tax advantage accounts, and we go into the taxable accounts, which isn't a bad thing, because if you pay taxes, it means you're making money. So I want to put it out there. But now while the options the choices becomes quite vast. You can go many different directions. The easiest way would then be again, depending on the goal that you're saving for, but let's assume this is for financial freedom goal, so 20 plus years in the future. The easiest way is just to start maybe opening a taxable ZAR account and investing in a global equity feeder fund. So it's priced in rands, but you get exposure to offshore funds, and that's probably the best growth you're going to get in that space. You can start thinking of converting your rands to US dollars and investing directly in global ETFs or individual stocks in this case, which is a bit more difficult. And although a lot of people feel like they can do that well, over the long term, statistically, it's very difficult to really outperform the market. But we'll maybe that's a discussion for another day. So there's those two options, and then you do get the kind of alternative investments that's outside of that scope, which we can touch on, but I think it probably make the video a bit too long today. But I think let's focus on those two. So either using rands, getting exposure to the offshore markets as a form of diversification and why that's important, or just converting rands to dollars and buying stocks or ETFs. I think that will kind of be the next step for me.
Yeah. So let's get into that. Global exposure, it's not, I think the mistake people make when they talk about global exposure is that they look at it as a better way from South Africa or something like that. And from my view, what you're actually doing is you're saying, if my time horizon, and let's use that, let's just make it up now. It's 24-year-old person who says time horizon's 25 years away. And I know when you're 24 and you're looking at your whole lifetime away from where you are today, if you're 24 and you're looking 25 years ahead, it seems like crazy, but it'll get there quicker than you think. Your time horizon is so long that you need to invest in markets, in economies, in geographies that you might not know much about. Equally, the reason you have to do that is because we don't know, none of us, I don't care who you are and how clever you are, no one knows what the next big economy is going to be, what the next big trend is going to be. Will it be India? Will they be the economic powerhouse of the world? Will everything we buy be produced in India, and will they be the tech behemoth of the world? We don't know. The truth is, you've got to be humble enough to say, I don't have a clue. Yeah. It could be that America reinvents itself and kicks off again, but even if that seems unlikely today, the same with the UK or China or anybody. So when your time horizon is a long way away, then what you do is you diversify far and wide so that you can take advantage of those opportunities, which argues in favor of global investing. That's the reason that you do it. Equally, for this person in this situation, they've got a decent South African exposure because they've got their emergency fund, they've got some other medium-term savings, which will most likely be in cash accounts, and they've got a retirement fund, which is probably at a region of about 55% in South Africa. So then the goal is to say your overseas investments in the early days, you should probably be looking at around about 25 to 50% of your assets. You should start to aim to say, I want those global. We're not saying, or I'm not saying, get it done tomorrow. Just saying that's your goal. So now you start to use cash flow to build up those global investments. I agree. Don't go and buy a dollar-based investment when you've got 10,000 Rand. Use a feeder fund, whether it's an exchange-traded fund, a unit trust. I don't really have a big preference there. I just think focus on costs and make sure you understand what you've got and make sure it's diversified. And then when you get to larger amounts, and I don't know what you think, for me it feels like somewhere around 500,000 Rand or more, then you convert those rands and actually send them away overseas into dollars, and then buy proper global investments in dollar-denominated. And we'll talk about currencies in a different episode because there's a whole thing around that. But I think debit orders. I love going into feeder funds because it's disciplined and you're phasing in, which means you're not worrying about market volatility. Trump, Xi, Putin, all of that. They can all do what they want. You're just going to keep going. I want to get to the individual shares that our listener owns and the question around market timing as well. But I just think for me, we're unfortunately aligning again, Pieter. So it's you've taken care of your short-term goals, your medium-term goals. You're building up your discretionary savings. I think that's the jargon. That means you're most likely going to pay a bit of capital gains tax one day when you sell. And we're telling you to do long-term things so that you don't have to sell, hopefully, for 10 or 20 years. But you actually want to pay capital gains tax. It's the most tax-effective way of generating tax, and so you don't want to be paying 45% on income tax, and that's a great story for another day. And I think we're also saying, because your time horizon's so long, don't take a specific view on the globe. Don't now go and say, I know that the Argentinian prime minister is doing a great job restructuring his economy. That's going to be the biggest economy in the world. You don't know that. You might believe it, but please don't invest all your money like that, because that could be great capital destruction.
If we all had a crystal ball, that would be awesome. If I just have to take it out under the couch. No, we don't. We don't have that. And we might have strong convictions in certain, predictions of what we think might happen. But if we look at the statistics, and it's now going a bit more in the active versus passive debate of which one is better. But if we look at the long term, even the experts struggle to beat the market. And when we say we beat the market, it means just buying a passive index funds that tracks like the top 500 companies in the America. They go all up. All of them go up. The index goes up. If they go down, the index goes down. To try and beat that means I'm picking, like cherry picking stocks that will in combination do better than that. You might be lucky 1 year or 2 years or maybe even 3 years. And especially in the last couple of years, since 2022, it's just been upwards trend with a bull market. So anyone's a genius. Anyone can buy stocks and think they've made it. But when the market drops, and it will at some point, it's gonna be sore. You're gonna feel it, because that's what goes up must come down. So what I found, and I went through that. Why I'm saying this is because I went through that period where I thought I can do it.
You're the genius.
I'm special. I can do this. It's easy. And it's easy when the markets go up. It's not so much fun when it goes down. And what I've learned was, if your time is already limited with having responsibilities, you've got work, you've got family, you've got maybe a career that you're building, you don't have time to look at all of these things and reading all the headlines, which is always negative in any case. Rather just make it simple, buy the world in a global, well-diversified index fund, or whatever you choose to do. Have that debit orders go off so you automate, because if the markets go up, well done, you're making profits. When they go down, well done, you're buying at a discount. So there's always a good time to invest. You don't try and wait. Say like, okay, but now today I read this thing, I think next is going to happen. I mean, if you enjoy that type of thing, fine, go buy your individual stocks with maybe 5% of your monthly contribution and play around with it, just as an experience. But definitely don't over concentrate all your investments on one conviction that may or may not play out. You may be lucky, but statistically you're not going to be, because it's impossible to really predict. I think most of the time it's just luck.
Yeah, I think, this, I mean, maybe just to touch on the active passive debate. So you get fund managers who will look at the world and say, we're going to allocate specific amounts of money to geographies or asset types, whether it's cash, bonds, property, shares, and they will do that differently than the market. And I think there is a big body of evidence that says it is very hard to do that. So why does someone like me, I mean, it's been something I've spoken about for years, why do I still allocate money to both? I allocate money to indexing, allocate money to those active. And I think it's, now we're in an environment, and I'm leading us to the second part of the question, because we're in an environment where tech shares in America have done phenomenally well. And if you were, I'm just going to say, lucky enough to have taken all of your money and put it all into, Apple and Nvidia, and well done. You've ridden your luck, and it's done incredibly well. But you're now in an environment where you've got shares that are trading at 50 years worth of profits at current prices. So that's, I don't care who you are. It's impossible to tell me that business will generate a much more growth in terms of share price from now. It might grow itself as a company, it might grow its profits and all of those things. But 50 years worth of profits for the current share price, and valuations matter. So for me, I'm going to buy the index with at least around about half of my money, but the other half I'm still allocating to those active managers. I'm not giving them the money because I think they're going to do better than the market, especially in good times. What I'm really hoping they're going to do is they're going to allocate money away from the expensive sectors, the shares, the geographies, to give me a chance to get some low value, or good value, in other words, low price, good value investments. And I'm hoping that 1 + 1 gets me to 2.25. That's the diversification. But let's get to the question, because we've kind of you've already gone there a little bit around choosing individual shares. And there are two questions there. One, the listeners bought individual shares that are now expensive, and two, that the question around, do we wait? Do we now sell at the top of the market and then buy in again when it's cheap? And I think there are two issues there. Do you want to hit the market timing question first, and then the individual shares?
Yeah, I mean it's a simple saying: time in the market beats timing the market.
Yeah.
That means is trying to time when it's at the top and when it's at the bottom. If we look back at those graphs, we go and type S&P 500 and look at the last 5 years. It's easy to say, yeah, but look at COVID, it dropped, and then 2 months later it was at the top and then it dropped. That's easy in retrospect. But looking into the future, everything will always feel like we're at the all-time high. It's always going to, because that might be the case, but 5 years later, we're probably not there yet. So you can try and do that and believe that you can and do all the technical analysis and fundamental analysis that you want, but it's very difficult to do and probably not going to get it right. So rather, what I would, at least my approach was not trying to do that, but just keeping a consistent rand cost averaging or dollar cost averaging into these funds. And then I can spend my time and just be happy about it and don't have to stress. Because if you're right, then that's great. But if you're wrong, it's stressful. So I don't believe that strategy works. Rather, just average your money into the markets every month. The sooner you get your money in the market, the better, because it allows it to grow and maybe earn some dividends. So I don't think, in this case, the viewer should be really concerned of trying to now buy because it's high and then later buy when it's low. There is some reason to rebalancing a portfolio if it's kind of you have certain targets for equity and bonds and cash, and now you've deviated a bit from that and then balancing. But I mean, at the age of 24, I don't think really that it plays a big role. I mean, you should be very much exposed to equities in any case. So in his case, I probably won't bother. Just keep it as it is and add to that, because that money, as I would assume, is going to be for 20, 30 years time in the future. So no point in really rebalancing that.
Yeah, and just the one thing there is a lot of the exposure, it sounds to me like a lot of that exposure is just in the US. So that is a concern, because now it's a specific geography. Yes, it's the biggest stock market in the world. It's the for now still the biggest economy in the world. But that doesn't mean it should consume all of your investments or the place where you house all of your. I think you ignore the rest of the world at your peril. So just considering the potential for Japan, as it's restructuring its investment markets, it's starting to deliver very good returns. I just think, countries like India and China that have very good, productivity, still low cost, all of those things, you can't ignore those. And who knows, Europe might actually sort themselves out and become a productive investment destination again. I don't have much hope for the UK, but equally, I think, if I'm in a situation, as you say, the person's 24 years old, maybe don't contribute more to the American market for now. What you do then is you start to build up your non-US global exposure, but don't go and take specific views. So get to the point where you can buy. There are either global unit trusts or exchange traded funds that are the world excluding America. So you might want to do that just to balance out your US exposure. If you do get to that point, then don't be afraid of just buying a global fund or a global world. I think they're called the All Country World Index ETF as well. So then you're not worrying about trying to match geographies and all that stuff. It's done for you. So I like your idea of don't now try and time the market. You're not going to get it right. If you sell now, what's probably going to happen is the market will double again in the next 3 years. Whereas if you hold on thinking that it is going to double, it's probably going to halve. So just get out of that whole game. Be humble enough to know that nobody knows, including yourself, and then keep adding to the portfolio. And then I just want to caution you on that US exposure. That bothers me a little bit. It's been a very good view and call for the last decade, which probably means that's not your best call for the next decade.
Yeah, it's all about investments. It's diversification, diversifying your risk, and probably still gonna have big exposure to US shares, whether you buy a global fund, because oftentimes the US makes up about 60% of that. So it's because just by nature, by default, they have done better. So I think great question. Well done. Again, being at the age of 24, having a fully funded emergency fund and maxing out your tax-free. and now sitting with the dilemma of not knowing what to do with the rest of your money. You're doing phenomenally well. You're spending time to educate yourself. So that's always going to be your best investment.
Yep.
We've talked a lot about investment vehicles and funds, but your best investment is your knowledge. So go buy books. Warren has written quite a few of them. Spend your time, invest your time to learn what you are already doing. So yeah, I mean, well done. It's phenomenal. So yeah, let us know in the comments if you're in a similar situation, what you would have done given what we've discussed now. What is maybe your strategy if you're similar age? If you've got any questions on what we discussed today, feel free to let us know in the comments or send us a voice note on WhatsApp. And yeah, maybe we will feature you in the future video.
And thanks so much for the questions. Keep them coming. We'll keep answering if we can. Some of the questions are really good now, and we have to do a bit of homework on these. And don't forget to subscribe. Thank you so much.
The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.